Hello again, everybody. I hope your first week is still going well. Let's jump right into Chapter 2 and see if we can get through these 40-some slides in about 15 minutes. If not, we'll do a second video. So in Chapter 2, we're going to look at an income statement, the balance sheet, statement of cash flows, free cash flow, performance measures, corporate taxes, and personal taxes. These may be things you've seen in Accounting 101 or Business 101 class, so I won't spend too much time on each one of these in particular. I really want to get down to the performance measures to focus on that. So let me get in presentation mode, might help us here. All right, because we've already seen this. All right, so an income statement, very simple, right? We have sales at the top, cost of goods sold, some other expenses, interest expense, our pre-tax earnings, our taxes, and then finally our net income. So if we look at this corporation from 2015 to 2016, we see a lot of things have changed here year over year. Number one, we see their sales went up quite a bit. But we also see that their cost of goods increased dramatically, at a higher rate than sales, and that's not good, obviously. And then we see some other expenses went up dramatically. Thus, at the end of the day, their pre-tax earnings were actually a negative. They lost money. One thing you will see is they did get a bit of a tax return, but their net income for the year was a loss of $95,000. So while they increased sales, which we all think that's great, if you don't keep your cost and other expenses in line, it's a problem. All right, so what happened, right? Their sales increased by over $2.4 million. Their cost shot up more than sales, so their net income was a negative. However, they received a tax refund because of that over the past 2 years. So now let's look at the balance sheet on the asset side and see what it contains. It's going to contain our cash, obviously. And then we've got accounts receivable, we got inventories, so our total current assets, right, 1.1 and then 1.9 the next year. Our fixed assets, we can see that those went up greatly year over year. And then you've got your depreciation. And then we end up with our total asset number. So that grew dramatically from year to year. So effect of the expansion on assets, we had our net fixed assets almost tripled, accounts receivable and inventory doubled, and then our cash and short-term investments fell. So that's what we can see from that statement. And if we go back, we can see all of those metrics pretty quickly. You'll probably want to go back and forth on these once you look at it on your own to really get a good grasp of each one of these different pieces of the balance sheet, income statement, so forth and so on. All right, so now we're going to look at the liabilities and equity. Very simply, we got the accounts payable and notes payable. So it's more short-term, long-term. And then we got a total current liability of 1.3. We have some additional long-term debt. And then we have common stock, and that's shown here on the liabilities and equity, because if everybody that owns stock in the company turned it in, we would have to pay that out, and we would have to reimburse that amount. So that's what that is. We've also got our retained earnings. We can see it's quite a bit lower from 2015 to 2016. And we'll go into that a little bit deeper, I believe, in some future slides. So total liability and equity, $2.8 million versus 1.4. Sounds good and bad at the same time. So what effect did this have? Current liabilities increased as creditors and suppliers financed part of the expansion. Long-term debt increased to help finance this expansion. The company didn't issue any stock, and retained earnings fell due to the negative income. We could see all of that. The big thing is they used debt to finance their sales expansion, thus driving up their cost. So we look at their operating activities in the statement of cash flows. Their net income for the year was a negative $95,000. We can also see some adjustments. So depreciation helped them a bit. Their change in accounts receivable, change in inventories, those were obviously a negative impact. Their change in accounts payable and accruals didn't offset that. So net cash provided by operations was a negative $500,000, basically, a little bit more than that. Their investment activities, obviously they needed to use cash that they acquired, so through loans for some fixed assets, we can see that. So again, a big negative on the statement of cash flows. Notes payable went up, long-term debt went up, payment of cash dividends actually went down. They paid less in dividends, and you'll see that later as well. So summary of the statement of cash flows: net cash provided by operations was a negative. Net cash to acquire fixed assets, that's a negative. And then we see the only positive is the net cash provided by financing activities or loans. So their change in net cash was a negative $1,718. Their cash at the beginning of the year was $9,000 down to $7,280. All right, so when we think about free cash flow, right, a company that doesn't have a lot of free cash flow, they're going to be in trouble because there are a lot of uses. The main 5 uses for that are to pay interest on debt, to pay back principal, to pay dividends, to buy back stock, and to buy non-operating assets. And when you think about investors and those looking to invest in your company, number 3 and 4 are big pieces of the puzzle that they're looking for year over year to see if their return is going to grow consistently. And obviously number 1 and 2 are very important for the longevity of the company as a general rule. So I'm not going to go through all this, but I wanted to point out this slide because I think it's a great slide that really brings together all the pieces of the puzzle. You can see how net operating profit is generated, and then your net investment in operating capital, and how that really comes together for your free cash flow. So I would definitely keep this handy and be able to use it. So now we're going to get into some different calculations and some different definitions, metrics, performance metrics. And why I like these so much and why I like to focus on these is when we start looking at these different metrics, it makes it real easy to compare companies side by side, even in different industries. That may not be the case with every one of these as far as like the total number, but when you compare year over year and you see the growth or decline, it's real easy to see which direction a company is going, especially over 3, 4, 5 years. So the first one we're going to hit is net operating profit after taxes. Very simple. It's our earnings before income and taxes times our tax rate, and you see that here. So in 2015, their net operating profit after taxes was $125,000. In 16, it slipped to just over $10,000. All right. So operating current assets are the current assets needed to support operations. That includes cash, inventory, receivables. They exclude short-term investments because these are not part of operations. All right, so current liabilities, same thing. Current liabilities are resulting as a normal part of operations, right? Accounts payable, accruals. This does not include notes payable. This is part of the financing activities that we talked about earlier, not part of operations. So when we look at net operating working capital, it's operating current assets minus operating current liabilities. Very simple. And again, we can see that working capital actually increased from 15 to 16. All right, so total net operating capital, also called operating capital, that is our net operating working capital plus net fixed assets. Again, we don't really need to go into each one of these line by line, but these are good performance metrics that you can look and compare and really get different insights into a company. Free cash flow for 2015. All right, so their net operating profit after taxes minus their net investment in operating capital. So for 2016, they ended up with a negative 1.1. All right, so how do we think investors reacted to this? I would say they reacted quite badly, right? Because there's no free cash flow to reinvest in the business or for dividends and stuff of that nature. So not a good picture here. All right, so another one we want to look at is operating profitability. Again, net operating profit after taxes divided by sales. And I like this one because it comes up as a percentage. So this one would allow you to compare, different companies inside and outside of an industry, different geographical regions, even in different currencies. You would be able to do that. So we can see that in 2015, the ratio here was 2.15%, and then in 2016 it dropped dramatically to 0.18. Right, so big drop here. To say whether or not 2.15 is good or not, that depends on the industry, the competition, stuff of that nature. So a lot of things go into what a good percentage is, but you can definitely use it to compare and contrast and see year over year how a company's doing. The next one we want to look at is capital requirement, right? This is the amount of operating capital required to generate $1 of sales. So basically, how much do you have to invest to make $1? And in 2015, they were at 19.5, and they almost doubled, 38.7% the next year, right? So we had to spend a lot more money to make that same dollar bill the second year. Our return on invested capital, it exactly is what it says it is, right? What is our return rate on our investment as a company? And we can see in 2015 they made 11%, all the way down to 0.5% in 2016. You're going to see a trend here because the numbers are the numbers, and they're pretty consistent throughout. But again, this just gives us multiple metrics that we can use to gauge and understand a company's performance on all different sides.